Let's start with what we're seeing this year in terms of activism. We've seen a lot of campaigns essentially asking for M&A as an outcome. Is that going to be the standard ask now for activist investors?
Well, first, thanks for having me back, and hopefully won't disappoint on the expert label there. I think we have seen actually M&A be an ask for activists over the last few years as they play to the strength of the market. The M&A market has been strong, fairly robust, and we've seen activists push for that as kind of a primary ask. I think if you look last year, it was the second most frequent ask after the sort of what I'll call the placeholder of board influence, which often did lead to M&A anyway. So it has really been a primary driver. I guess the question will be, what is the next, if you will, in terms of how they go? But certainly we have seen
what is it? You're the expert. You can answer that question.
Well, I think there's kind of two fronts that we're seeing. I think one front is the topic of ESG, where we're seeing activists start to use that more as an actual driver of some of their campaigns. And I think the one that's obviously leaked into the market a little bit earlier, and we saw it last year and kind of expect to continue, is activists becoming more of the private equity style, and that is going in and taking companies out of the public markets, becoming the owner, not just putting a bid forward, hoping that a private equity player comes and takes the company out, but rather they themselves putting that bid in and becoming the owner and operator of those companies in the private market.
Yeah, that's an interesting point around convergence, right? And we've seen it with the activists in private equity. We've also seen it with the activists and the more traditional sort of long investors. Activists have gotten nicer, long investors have gotten a bit more vocal. The question then is, what do activists have to do to justify that fee delta? Because if I'm putting my money in with an activist, I'm really expecting them to do something much more aggressive and alpha delivering than a traditional investor.
Look, I think we're obviously in a market and we're in a cycle right now where the S&P, for example, has been a tremendous performer, and it's been difficult for all of the active managers to outperform. Although last year, I think if you look, a lot of the activists did outperform the S&P, and their portfolios performed very nicely. So I think there's obviously that. Performance is always going to be the driver or the justification for fees. I also think that if you look at some of the situations, even where it's not apparent to us that activists are having a difference, where the market is giving them credit even when they first show up, because there's an expectation, sort of it's sort of the inverse of the fact that prior performance is not indicative of future performance. There's certainly a lot of situations when a lot of the better known activists where that prior performance or past performance is something the market is expecting to see repeated, and we see immediate responses and immediate pressure on companies because stock prices are going up in response to an activist presence.
Is that why we started to see activists show up in some of these very big, what I think of as sort of more defensive companies like AT&T, potentially like SoftBank, where simply by being there and having a reputation for being bruisers in the past, they're able to engender change?
To speak about that in sort of a general sense, I think we're starting to see activists just overall looking at maybe some more defensive positions. If you look at activist portfolios at the 2019, I think what you'll see is a lot more of the utility names, a lot more financial names, things that are generally considered to be much more defensive positions than where you might expect to see an activist show up. I think we've also seen the dividend yields on activist portfolios increase from about 1.2 to 1.6% since 2014, a 45 basis point increase, whereas the S&P over that same period of time is down on a yield perspective. I will also tell you that, interestingly enough, in the fourth quarter of last year, the largest single investment by the group of notable activists that we at Barclays follow was an investment in the S&P 500 SPDR for north of $800 million. That strikes me as a somewhat defensive approach to the market.
That's not the most exciting, juicy thing to pursue. So look, just to end on, if this is going to be the new norm for activism, what does it mean for the smaller activists who are trying to get into the market and don't necessarily have that reputation?
Well, I think where their focus are going to still be on the smaller cap names. I think we've talked in the past, Ed, about this notion of sort of barbell activism, where you have the smaller activists focusing on the smaller cap names, and you have the larger activists who are going sort of upscale and focusing on some of the larger names that you've mentioned. And I think for those small activists, that's where they're going to make hay and where they're going to continue to work. And look, we see a lot of that activity, and we see a lot of companies in that sort of size range, I'll say $2 billion and below from a market cap perspective, where we are working with companies to be out in front of the risk of activism. And we're seeing activists who are showing up and thinking that those companies maybe don't belong in the public market because of the negative performance that sort of indexing has pushed on those companies.